Hello, everybody. Bobby Piton here with Preactive Investments, doing a market wrap for today, March 8th. It's been an interesting day in the markets. Things kind of started up they started down overnight, um, flattened out, and then they gapped up um, by this afternoon. And now, after gapping up this afternoon, we had a really big sell-off, especially in with regards to the risk assets. The risk assets being emerging markets. Um, the Nasdaq, I guess, is viewed a little riskier because of what's taking place with regards to interest rates. For for those of you who aren't keeping track of what's taking place with interest rates, as the interest rates are moving up, and we've talked about this a little bit, or I've talked about it, going up by 1.4. The 10-year going from 1.4 to 1.6%. It ripples through the entire market system on how things price. And the other thing that I think is spooking people is this concern about inflation. And so inflation is something that the Fed wants to create in the economy by about 2% per year. And last week, I said it. I already said it last week when it came out, and I don't think a lot of people were paying attention to it. But the wage growth number of 6% is extremely alarming relative to what the productivity growth rate was. That productivity growth was nowhere near 6% to offset those wage increases, and now the stimulus passed. Passed the Senate on Saturday, and so I think what's starting to happen is people are concerned that the entire yield curve is going to shift up. And if the yield curve shifts up, then that means that all these other assets that were benefiting from lower rates, because of how a low environment, a low interest rate environment, shakes people out of those assets that they don't feel they're being paid enough, and chases them into assets that they think will generate returns. Now, this can be a virtuous cycle on the front end, but then it can turn into a vicious cycle. And I don't know which is going to happen. And I'm not claiming to tell anybody what is going to happen. I'm just explaining what we've been seeing in the action today. The 20-year Treasury, which is there's an ETF that you can look at called the TLT, that dropped another dollar today, which is about 80 basis points. Now, keep in mind that this thing only earns 2.3% a year. So if you make 2.3% a year on your money, and the thing drops 0.8% in one day, and this is after it dropped from a high of 180 last year to 138 today. So it dropped $42. So you lost basically 10 years of income by that fall if you were a buyer. So if somebody bought that bond at 180 last year, the U.S. Treasury, no credit risk, 20-year bond at 180, and it fell $42. You're talking about not exactly 10 years, but probably like 9 years, somewhere in there, 7 and 9 years worth of 2.3% return now for you to get back even, assuming rates don't go up even more. And so this is always the risk you run, and you can see that bond, which is risk-free government money, that bond fund to fall from 180 to 138. You can imagine the impact on technology stocks, which are disproportionately impacted by rates going up or down. They tend to have a larger delta. And so in the past couple weeks, week and a half, the Nasdaq is down, I think, a little over 11%. The Nasdaq Composite was down 2.4% alone today. But then if you look at the larger Nasdaq stocks, the QQQ, that was down almost 3%. It was down 2.83% today. So that kind of fits this concern about interest rates moving up. And so a couple things I also want to mention, which I thought were interesting to note. I mentioned this morning oil prices had spiked because of this attack on Saudi Arabia. The generic futures contract for oil, it hit almost $68, $67.98, and then it sold off into the close. This is within the same day, mind you. It sold off to a price of about $64.78. So it pulled in basically almost 3.5% in one day after hitting the a peak of almost 68. So now you have oil sold. So that contract sold off. You had metals sell off. So gold and silver sold off today too. Gold about 1%. So we have a situation where rates might be helping correct some of the inflation, because that's what's happening. If there's an inflation concern or scare, and people drive up the yield curve to kind of slow down that possibility of inflation, well then if there's less inflation because rates are going up, it puts some pressure on gold and silver, because people buy gold and silver when they think there's going to be inflation that's not controlled. So it's counterintuitive, maybe not counterintuitive, but if you sit and you make a bet that you think there's going to be a lot of inflation, you want to own things that are going to hold their value with that inflation. But the moment it starts to correct itself, the very things that you were buying to hold value to protect you from inflation might actually fall. So it's a really tricky situation when you invest or trade in these things. And this is why it's extremely important that if you're going to do it, you don't know how to size your positions properly, that you find a professional to help you do it, because you can lose a lot of money very fast by doing things that you thought were protecting yourself but actually end up hurting you. The last, I think, legal challenge that Trump had before the Supreme Court about the election was rejected today. That made some news. Arizona, I'm not sure if people saw, but I think there's some articles that came out on the Gateway Pundit about some ballots being shredded and being found on a facility in Arizona. And that might be a story that's going to develop, but it's obviously there's 2.1 million ballots in Arizona that they're going to audit or review to see if in fact there was any sort of voting irregularities. Time will tell if we're going to spot anything there, but that's a little bit of an overhang, because a lot of people don't know if they can trust and believe the process. So only time will tell if in fact people believe in the results and that they're credible in terms of the process that was followed. So that's out there. That came out this weekend, and I'm just mentioning it now because, faith in our democracy, faith in our election process and system is critical to trust, not just in our government, but trust in our financial markets. If we don't have trust in our government, then the risk premium on government bonds, the risk premium throughout our entire system will ripple up higher. Think of it when you look at countries where we believe there's elections that are rigged or thrown. Historically, countries in South America or countries in different parts of the developing world where they have a history of abuse of the voting process. And who knows, who knows which state actors have been involved with that. Maybe it wasn't even the people of those nations. It might have been malicious other nation states that did it. So I have no idea. I'm not saying who's responsible. I'm just mentioning that when this happens, the equity markets in each respective nation, as well as the bond markets in that nation, if there's a loss of trust and credibility in how things are being managed, can spill over into the money, the value of the money and the value of the assets within that nation. And I'm just saying that, for the United States and other nations that have these issues that we've seemed to have in the last election, it could start to undermine people's faith, not just in the democracy, but faith in the overall financial system and the assets in the system. And that would be a horrific thing to have happen for a lot of different reasons. And it can lead to a far more greater amount of pain than we experienced last year, caused by the virus. If you have a complete breakdown of trust and belief in the system, you have situations that get extremely dangerous and spiral out of control, like we've seen what happened in Venezuela, and then not too distant, I guess in the past few years, where you have essentially, the whole country, starving to death, and people losing 30, 40, 50 pounds, not by choice, but because there's no food. And this is what ultimately happens with communism and socialism. And I do believe there are some people that are trying to undermine our democracy as well as our capitalist system to try to bring about this type of socialist, communist evil onto our soil. So basically, that's what I wanted to mention. Oh, one last thing I wanted to mention. The CDC basically came out and said maskless people, can go visit each other if they've been vaccinated. So I'd like to issue a statement to the CDC. Bobby Piton is not going to get vaccinated, and I will gladly visit anybody who is vaccinated without a mask. And I encourage other people to consider doing the same, because if that vaccine supposedly works, then you shouldn't have any worry about going to visit that person that was vaccinated without a mask. Anyways, just a thought. But in terms of, is it ever a good time to start or bad time to start investing? My short answer to that is it's always a good time to start investing. Now, what does that mean if you're investing? It doesn't mean that you have to buy or sell anything to start investing. Investing might be putting money aside in preparation of buying something that you think makes sense. Think of it as, for a simple example, not in the stock market. If you thought you may want to buy a rental property, you might want to start putting aside money to purchase that rental property. And it doesn't really matter where you put it right now because the banks are paying zero. But let's just assume you're just stockpiling cash. and then you eventually took it to the bank. So, they're going to run a report if you put too much in at one time. But, that's a whole nother story. I'm just hypothetically saying, if you save the money and you're waiting to buy a piece of property, and then upon saving enough money to buy that piece of property, you're waiting for the right price to buy it. And are you investing or saving? I would argue that just putting money into cash and knowing that it's segmented for a future investment is investing. So my definition is a little different, maybe a little unconventional, but don't feel like just because there's money in your account that you're putting aside to save or invest, that you have to do something immediately. When you go looking for a different home to buy, if you're if you've never bought a home or you bought a home and you're looking to buy another home, you don't necessarily feel the need to buy the first thing you see because the money's burning a hole in your pocket. But it's available to purchase a home and to invest. And I think that's an important thing to do. In terms of learning when the right time, what to buy and what to sell, there's a lot of, news sources out there now where there's encouraging people to self-invest. I strongly question the way some of that stuff is done. I'm not going to speak to which ones, but you should explore those strengths and weaknesses of investing your own money versus hiring a professional of some sort to manage the money on your behalf. I think it's a mistake to think that you can keep track of everything going on in the markets and do your job and raise a family and run a business. The list goes on and on. Now, I understand that I have a lot on my plate, but the big difference between me doing some of the things I'm doing with regards to doing some stuff with Voter Information Project, I do some of these videos. I've been doing this for I guess about well over now, almost 25 years, and I have a lot of data sets already built that didn't get built overnight. It took me years to build them, and different types of ways of analyzing things at a fraction of the time that someone else might take 5 or 10 hours to analyze something. I might be able to spend 15 to 30 minutes if I have the right material and really think about what's happening. And so you should know what your strength and weakness is if you're going to invest your own money. And you don't want to, you don't want to think that you're smarter than you are with it, because if you misjudge how much you know, it can be extremely costly. So as long as you know that if you're wrong, what the consequences are, I think you should definitely look to invest your own money. If you don't like the consequences of investing on your own, if you're wrong, because you just don't have perspective as to how often you're going to be wrong, and what does that look like when you're right versus when you're wrong, you really need to you really need to examine that. And when I make a mistake in the markets, I know how to assess why I made the mistake. Like where was I off on my analysis, and I look to see if something changed in my thesis, or something changed in the flows into that particular sector, or if things changed in the interest rate. I can identify why I lost money. If you can't identify why you lost money, and it's understandable to you, then you're not really investing. In my opinion, you're gambling. Like, you should know why you lose when you lose, and what's causing it, and you should know why you win when you're winning. And if you can't distinguish between the two, it's, in some respects, it's kind of like playing poker. If you don't know what hands win for you, it's probably a bad idea to play. And maybe you should watch somebody who's playing for a while before you start playing yourself, or play digitally, so to speak, with no real money on the line, and then figure out if your decisions would pay out the way you think they would. Because the way you do something on paper or in a hypothetical is a lot different than how you're going to behave with your own money. So anyways, I hope you guys find some of the points that I've made useful, and I hope that you guys are finding value out of this. And if you are, I'm going to be doing this at 7:45 in the morning, and 4 o'clock after the close, and posting these videos. And I hope that as I continue to post more, I'll come up with different ways to just kind of keep teaching some of these investment principles. Maybe I'll try to do some mini or micro classes of sorts, where I explain one key concept about investing for 3 to 5 minutes, because it seems as though the school system is it's done a horrible job for a lot of people, and then there isn't a lot of really good education of this material that makes it easy to absorb. And I hope that some of my explanations help you process the information a little bit easier than just kind of reading it and not knowing how to relate it to what's happening in the economy. So thank you guys for chiming in, and I hope you enjoy the rest of your evening. Thank you.